Global Crossing, the bandwidth illusion. In 2002, Global Crossing filed for bankruptcy. At the time, it was one of the largest corporate collapses in American history. The company had been valued at $47 billion just 3 years earlier. But here's the thing that kills the narrative about market timing or bad luck: Global Crossing never made a profit. Not once. Not in a single year of its existence. A company that was worth nearly $50 billion, that connected 700 cities across 70 countries, that was technically ahead of its time, never earned a dollar. This is the story of how ambition, debt, and accounting creativity built a ghost. Global Crossing was founded in March 1997 by Gary Winnick, a former bond trader at Drexel Burnham Lambert. His team included 3 CIBC bankers, Abbott Brown, David Lee, and Barry Porter. They raised $35 million in that first year. But the late 1990s weren't a time for patient capital building. This was the dot-com era. Investors didn't want to hear about steady growth, they wanted to hear about scale, dominance, and the future. Winnick understood this language. In 1998, he hired Robert Annunziata, a 13-month CEO who would resign with $160 million in compensation. In July 1999, Global Crossing spent $885 million to acquire Global Marine Systems, a company that maintained undersea cables. 2 months later, in September 1999, they dropped $9.9 billion on Frontier Communications. That same month, they partnered with SoftBank and Microsoft on a $1.3 billion Asian network venture. In November, another $1.65 billion acquisition of Racal Telecom. By January 2000, they'd formed a $1.2 billion joint venture with Hutchison Whampoa. In less than 3 years, Global Crossing had committed to spending roughly $15 billion on acquisitions and partnerships, while generating zero revenue from operations. This wasn't expansion. It was a company constructing its own valuation through debt and deal announcements. The business model was theoretically sound: build a global fiber optic backbone, sell capacity to other carriers and enterprises, layer in managed services and VoIP. Global Crossing was even technically innovative. It deployed IPv6, the next generation internet protocol, natively across its network before almost anyone else. But innovation and infrastructure don't matter if you're buying your way to size faster than you can monetize. In March 2000, Leo Heindery took over as CEO. That September, Global Crossing announced a $6.5 billion deal to sell its web hosting division, Global Center, to Exodus Communications. The stock price collapsed. By the time the deal closed in January 2001, it was worth only $1.95 billion, a loss of roughly $4.55 billion in paper value in 3 months. Heindery resigned. The company hired Thomas Casey, a lawyer, as CEO. The signal was clear: this was no longer a business being managed for profit. It was a legal problem being managed for survival. Here's what the bankruptcy filing eventually revealed: Global Crossing had been involved in what the SEC called round-trip transactions with other telecom companies. Essentially, 2 companies would sell each other the exact same amount of capacity at inflated prices. No value was created. No customer was served. But on the accounting sheet, both companies recorded revenue. It was a two-way shell game disguised as commerce. But the real secret wasn't the accounting tricks. Every telecom company was doing variations of this during the bubble. The real secret was that Global Crossing's executives, including Winnick, knew the business would never be profitable at the debt levels they'd incurred. The acquisitions weren't investments in future growth. They were bids to hit a size threshold before the market realized the model was broken. Think about the timeline. In 3 years, Global Crossing went from startup to $15 billion in commitments. But the company was building infrastructure for a market that didn't exist yet. Bandwidth wasn't scarce in 2000, it was abundant and getting cheaper by the month. The assumption was that demand would eventually catch up to supply. It didn't. Not for years. And by then, Global Crossing was dead. The hidden logic was this: if we build it fast enough, if we get big enough, if we become indispensable to the backbone of the internet, we can charge enough money later to justify these costs. It was a bet that scale itself would create moat. Instead, scale created only debt. Global Crossing's collapse teaches something that doesn't age: size is not a strategy. It's a cost. A company can be geographically vast, technically sophisticated, and operationally complex, and still have no business model. The bankruptcy wiped out shareholders and employees, but it took 11 years, until 2011, for Level 3 Communications to acquire the company's assets for $3 billion, including assumption of $1.1 billion in debt. What Global Crossing built was real. The fiber optic cables still exist. The network infrastructure is still in use. But what they built was infrastructure, not a business. That distinction, between building something valuable and building something profitable, is the one that costs everything when you get it wrong.